This is the Financial News Network. I'm Chuck Pierce. With earnings season in full swing, investors are watching many companies, specifically internet businesses, after the popularity of online IPOs such as LinkedIn and Pandora. Two web giants, Google and Yahoo, have already released their earnings for the quarter. Here to discuss their reports as well as their future outlook is analyst Clayton Moran of the Benchmark Company. Thanks for being with us, Clayton.
Nice to be here.
Let's start with Google. They released their earnings last week with an EPS of $8.74 and revenue at $6.92 billion. What was your initial reaction to these earnings?
Google's report was very impressive, well ahead of street expectations. The bottom line earnings per share, as you said, $8.74, was almost $1 better than what the street had anticipated. And essentially, Google's seeing good momentum in all of its businesses, the core search business, as well as its emerging display and mobile. So very strong quarter for Google, and the stock responded.
All right. Now, speaking of their different businesses, they branched out a lot in many different areas and markets, and including now the social media with their beta release of Google+. How do you see this product affecting the future of the company and its earnings?
Well, I think it gives investors hope that Google can compete in the social media space. This is obviously a rapidly emerging space dominated by Facebook, and Google has yet to have anything meaningful within social media. But Google Plus is off to a very strong start, over 10 million users already, and it's only in a trial period. So hard to say whether Google will be successful here and really pull meaningful market share away from Facebook, but we can certainly say that they're off to a very good start, and they have a chance to do something meaningful.
Okay. And as for your rating and price target for Google, has that changed at all?
We actually didn't change either. We have the stock rated a buy. We have a $700 price target. We felt for a while that the street sentiment was overly negative on Google. Google has shown accelerating growth for about 8 quarters in a row now, yet the street continued to treat it like a value stock. I think this second quarter report was so powerful that now the street has to begin to view it again as a growth stock and give it a more significant multiple. So our $700 price target to some extent reflected and still does reflect a transition back to more of a growth valuation. We're using 20 times earnings to get there, still not what I would consider aggressive, but more reasonable for a stock that's growing its earnings per share about 17% or so per year. The stock's currently trading at 17 times earnings, so right at a 1 ratio to its growth rate.
Okay. And now taking a look at search site Yahoo, they just released their earnings yesterday with an EPS of 18 cents and revenue of $1.08 billion. Was this in line with your estimates there, the Benchmark Company?
Completely the opposite story with Yahoo. They missed on estimates. Their outlook going forward was also disappointing. And really, it's amazingly the continuation of a very long trend here where Google outperforms and Yahoo underperforms.
Okay, and now there are talks that Yahoo is looking into this acquisition with the online video site Hulu. Could this help them in getting out of this downtrend that they've been going at for a while?
It could. I doubt that it will. Of course, we don't know if they end up buying it or not. It's certainly been speculated that they're one of the lead candidates to buy Hulu. My fear is that Yahoo doesn't have a great history of integrating tech companies, so there could be some integration issues. And also, of course, Hulu has a significant reliance on its current owners for their media content, and so we'd have to see whether Yahoo got a long-term agreement to exclusively provide that content. That's key to the overall Hulu sale here. So Yahoo could buy Hulu, but I'm not really convinced that would change the Yahoo trends meaningfully.
Okay. And have you changed your price target and rating for Yahoo after this report?
No, we left both of those unchanged as well. We have a hold rating and an $18 price target. That 18 is probably looking a little bit aggressive today with the stock at 13.5. But the story here is the operations continue to struggle and lose market share, but at the same time, Yahoo has major stakes in Asian internet companies that are highly valuable. We put the value at about $10 billion, so more than half the overall value of Yahoo's company. So those Asian assets are supporting our price target.
All right. Well, great. Well, thank you very much for being with us, Clayton. It's great to look at the different stocks at Yahoo and Google.
Sure. Thank you.
All right. For more earnings, news, and analysis, keep it here to the Financial News Network. I'm Chuck Pierce.